Hello, we are Group 6, and I'm going to briefly mention everything that we'll cover in this presentation. We're going to go through what the original project plan is for Snowy Hydro 2.0 and explore a proposed alternative to achieve the same outcome. We're going to analyze the financial metrics of the company before beginning the project and analyze the financial indicators and resulting viability of the original project and the proposed alternative. We will also perform a risk assessment of external factors, including probability and sensitivity analysis, and it will conclude with our findings and final recommendations moving forward. Snowy Hydro 2.0 is a project being run by Snowy Hydro Limited that aims to add 2.2 gigawatts and 350,000 megawatt hours to the existing electricity grid. Two dams, Tantangara and Talbingo, will be linked by 27 kilometres of underground tunnels and a power station. Excess electricity will be used to pump water to Tantangara, which sits at a higher elevation to store water as potential energy, and it will be released to Talbingo during times of low supply through a power station to generate electricity. This project will benefit both Snowy Hydro Limited and Australia as a whole. It will enhance the company's market position by selling electricity at competitive prices and increasing their profit margin once the initial investment has been recovered. It will also benefit the rest of Australia by supporting the transition to renewable sources of energy by providing necessary energy storage and supporting cheaper electricity prices, helping businesses and individuals alike.
To assess their financial status before beginning the Snowy Hydro 2.0 project, we can extract the important metrics from the 2016 to 2017 financial year annual report. From these metrics, we can then calculate the relevant viability indicators. The company has a debt ratio of 0.41, which means that a significant portion of their assets are funded by debt rather than equity. A ratio of 0.41 means the company was using debt funding responsibly but is not overly dependent on it. A current ratio of 1.05, which is above 1, indicates that the company is able to cover its short-term liabilities. However, this would decrease once development of the Snowy Hydro 2.0 project begins. A quick ratio of 1.03, which is also over 1, means that the company can immediately pay off all its current liabilities with its liquid assets without relying on its inventory. Total assets turnover of 0.70 means the company generates 70 cents in revenue for every $1 of total assets in a year. This is reasonably efficient in the energy sector. The company turned a profit margin of 0.12, meaning that for every dollar in revenue, the company earned 12 cents in net profit after covering all expenses. This is a healthy profit margin for companies in the energy sector. Return on equity of 0.16 demonstrates strong financial returns to shareholders, indicating that the company is efficiently using its equity base to generate profit. Overall, these financial indicators prior to the implementation of the Snowy Hydro 2.0 project indicate a solid financial foundation for a company which specializes in the energy sector. Replacing the Snowy Hydro 2.0 project with an equivalently sized lithium-ion battery site would still be capable of supplying clean energy when intermittent renewables supplies drops below demand. Given the 15-year life of lithium-ion batteries, they will need to be replaced every 15 years to match the projected 50-year life cycle of the hydroelectric dam project. As for the cost of each alternative, the capital investment required for Alternative A is $12 billion, while the capital investment for Alternative B is $6.77 billion. While the cost to upkeep Alternative A per year is $52.8 million, the cost to upkeep Alternative B is $169.29 million.
The annual benefits listed here are sourced from Snowy 2.0 Updated Business Case, which was published last year. These can be applied to both Alternative A and Alternative B. The main annual benefit comes from storage value, listed at $580 million per annum. This is effectively buying energy at a low price and selling energy at a high price. The second largest annual benefit is the wholesale firming and capacity sales, listed at $370 million. This is trading electricity in the open market, guaranteeing reliable supply even when renewables underperform. This is the cash flow for Alternative A. This table does include inflation at an assumed rate of 2.5%. We have calculated the construction period is between 2024 and 2028 and will be the same as the 2025 graphs in the years between. During this period, we investing $2.4 billion of capital investment. And the funding, as listed, is split between equity and borrowed funds. The borrowed funds must be repaid over a period of 50 years at an assumed rate of 5.7% interest. Once the project comes online, we can see that we are instantly in the positive cash flow, and that continues until project is completed in 2078. This is the cash flow for alternative B, which also includes inflation. There are several differences between the cash flows, one of them being that the construction time is much shorter for alternative B, starting operation in 2025. The other major difference is that due to the shortened lifespan of lithium-ion batteries of 15 years, this requires reinvestment every 15 years, as can be seen in the year 2040, requiring a large capital investment. This was assumed to be at 50% of the initial capital investment in the cost in 2040, due to the fact that all of the infrastructure is already set up. This reduces the profitability of the alternative B over the long run.
In almost every single metric, the hydro scheme turns out to be a lot better than the battery-based scheme. The battery-based scheme might hypothetically have a shorter payback period. However, in every single other metric that is measured, here shown is NPV, BCR, and LLC. Hydro performs better. It's got a smaller cost over its lifespan with the LLC. It's got a higher NPV, net present value, but most importantly, the benefit cost ratio is far, far higher in the hydro scheme. With the batteries, it's less than 1. Hydro, it's 10. Having a ratio between the two of less than 1 is extremely not viable and means that this will not be able to be done on this scale. The hydro scheme is very viable. However, that doesn't mean that it wouldn't have some economic risks. But with those economic risks, the majority of them have a low to medium probability. While some of them might have a high impact, the fact that they are low to medium probability mean that they never get to the truly risky level that some other projects might have. The most dangerous economic risks in this regard are the adverse geology, the environmental approval process, as well as community opposition. So essentially, people might oppose it being put there in the form of the environmental applications, the local communities not liking it being there due to water levels rising, etc. And the thing that is most likely to not change is the regulatory changes when it comes to building said hydro plant.
Based on the risk matrix, alternative B, battery storage exhibits a high concentration of medium to high risk factors, particularly in areas related to cost, supply chain, and operational performances. One of the most significant risks is the volatility of global battery material markets, especially for lithium, cobalt, and nickel. These materials are essential to battery production and are subject to price fluctuations driven by geopolitical tensions, supply-demand imbalances, and increasing global competition, particularly from the electric vehicle sector. These fluctuations create substantial financial uncertainty, especially for large-scale projects requiring long-term procurement planning. Another major risk involves battery degradation over time. Lithium-ion batteries experience a gradual decline in storage capacity with repeated charge-discharge cycles, reducing their effectiveness and economic value over their lifespan. This degradation leads to performance losses, more frequent maintenance or module replacements, and potentially reduced revenue from energy arbitrage. In addition, battery systems have a comparatively short operational lifespan, typically around 10 to 15 years, significantly shorter than pumped hydro or other long-term infrastructure options, which increases lifecycle costs. Lastly, while batteries provide fast response flexibility, they are less suited for large-scale, long-duration energy storage, which is essential for grid reliability as the renewable penetration increases. This limitation makes battery storage a less dependable backbone for future energy security, especially during prolonged periods of low renewable generation or high demand. Based on the financial evaluation, sensitivity analysis, and risk assessment, the alternative A, the pumped hydro expansion, is recommended. Although it requires a higher upfront investment, it offers a significantly higher net present value, lower long-term costs, and a 50-year operational life, making it more financially sustainable. In contrast, battery storage faces greater uncertainty in cost and performance over time. To strengthen this decision, we recommend further analysis on water availability, energy market trends, and climate impacts to support long-term planning.